But amongst my circle, which once again, my clientele is going to be mass affluent and up, self-employed individuals, self-employed small business owners, and real estate investors. Am I seeing an exodus of people? No. It's very difficult to immigrate to a new country, even if it's, let's say, the United States, and then set up shop there. However, what has been happening with my clientele is there's been a lot of interest, and some people have pulled the trigger on investing south of the border.
All right, guys, back in the studio again. Fabio Campanella, Quentin Cordick.
Yes, sir.
Taxes, more taxes. We're obviously going to be talking about the capital gains tax, which a lot of people have been obviously concerned about and worried about. And, you know, should I sell now? Should I not sell? So why don't we kind of just jump right into it? Let's not waste any time.
Sure.
So
sure. Right.
I think first off, why don't we get a good breakdown of what is the new change in regards to the capital tax, and then what does that cover? Like, is it just real estate? Because look, this is a real estate podcast, so people think, oh, it's just real estate, but there's more that's being impacted by this, right? We're talking about stocks, we're talking about small businesses. What else?
Well, any sort of investment income, right? So I think that what needs to be understood is, first and foremost, what is a capital gain as opposed to some sort of other gain, okay? So a capital gain is a gain or an increase in value realized by an investor on a piece of capital property. And what is a piece of capital property? And the way I like to explain it is this. Let's say you want to become an apple farmer, all right? And you want to sell apples, all right? And you buy an apple tree, like a seedling, and you grow it into an apple tree. And then apples come, the apples are grown. You pick the apples, you sell it. Those apples are your inventory. You sell them, that's your business profit. 30 years goes by and you want to retire, and you sell that apple tree, and you bought it for $1 and you sell it for $100. You were never in the business of selling that apple tree. You were in the business of selling the apples. The apple tree, when you sell it, is a piece of capital. It's a capital investment to you. And the gain on that is a capital gain. Now, let's flip it around. Let's say you are in the business of buying apple tree seedlings, let's say, growing them, and then flipping those apple trees, those young apple trees, to apple farmers. That apple tree, it's the same asset that the first individual had, but that's going to be business income to you, because the apple tree is your business,
right,
not the apples, right? So we need to understand what a capital asset is. And it's an asset that you buy without the intention of gaining a profit on it to flip it down the road, right? You're using it for some other purpose, all right? So a capital gain has historically, at one point, it was never taxed. All right. But then it's gone through, and I have the actual rates here, but it's gone through different types of inclusion rates over time.
All right. So this is, yeah. So, okay. So I think I got that breakdown, which is interesting. So with real estate, if I have a house and I'm flipping it, that's active. But if I bought the house and I keep it and I rent it out, that is capital gains, because I'm using it for a different purpose.
You're using it. Yeah. You're buying the property to generate a rental income.
I never heard it broken down like that before.
And that's basically what a capital gain is, right?
Yeah.
You buy a property from a real estate perspective. You buy a property with the intention of using it for your business to generate business income, or using it to put in a tenant and generate rental revenue for yourself.
Okay. So let's get through the whole misconception of it now, because people now are obviously, they're panicking a little bit, okay, or not even understanding it. But what is the capital gains number if I bought a home for $100,000 and I sell it for, let's say, $500,000? What is the part that's being taxed on? Is it the full amount where I bought it, right?
It's the gain,
okay,
right? So you bought it for 100, you sold it for 500. $400,000 is your profit, right? Or the gain.
Okay.
And that is your capital gain.
So it has nothing to do with the mortgage pay down.
Nothing.
Okay, got it.
Yep.
So now 400,000. So now let's go through the new rules that the government is coming out with. So prior to the new rules coming in, it was 50% of that 400,000.
Right. So we have to distinguish between a capital gain and a taxable capital gain. Right?
Yeah.
So a capital gain is the full gain. The taxable component of the capital gain up until June 25th this year has been 50%. Meaning that the government's like, look, you sold this capital property. It wasn't your intention to to buy it as a piece of inventory. So we're only going to include 50% of that gain into your income.
And why don't we kind of use this as an example? So we'll pretend, So this is like an example of what you kind of just run through the scenario so that people can see the difference of what it used to be and what is going to be.
Sure.
Okay.
So in this particular example that you've given me, we have a $300,000 capital gain, meaning that 50% of that $300,000 is going to be your taxable capital gain. All right, that's going to get added to your income and taxed at your marginal rate. All right.
Right.
So your tax rate at the highest percentage in Ontario is 53.53%. You work the numbers here. I'm trusting that the numbers are correct and they look correct. That means on that $300,000 total gain and the $150,000 taxable gain, you're going to pay just north of $80,000 of tax.
Because half of that is not taxed.
Half of the total gain is not taxed.
Okay, got it.
Okay.
Cool. Yep.
And that will give you your average tax rate or your on that total gain of 26.76%.
Okay.
Half of your marginal tax rate.
Yep.
Okay. That's assuming you pay tax at the highest marginal rate.
Right.
In Ontario.
Okay.
Right? Perfect example. Now, what is the government proposing to do here? The government, as part of their policy, is saying, hey, listen, super rich people are evil and they need to pay more taxes to support this government and whatever. And you can have whatever opinion you want, right?
Yep.
But the idea is that the current Liberal government, and the policy is backed by the NDP, not backed by the Conservatives, but it's going to pass because the NDP and the Liberals will can get it through. What they're saying is
a coalition should be illegal, but I don't want to get too much. It's so ridiculous. It's so
politics
ridiculous.
are like way beyond my cognitive capacity. All right, I just don't understand.
Fine, we'll stick to taxes.
I only know my job as a tax and financial advisor is to take whatever the rules are right now and make sure that my clients get the best out of it.
Fair enough.
So from that particular perspective, what they are saying is, listen, if you in any given year have capital gains that exceed $250,000, the first $250,000 will be an inclusion rate of 50%, like always. All right. And anything above that will have an inclusion rate of 2/3, meaning that you will be taxed at a higher amount. What is the net effect? The net effect is that there's going to be significant amounts of tax, in my opinion, on people who have very large gains. And I think this is going to have unintended consequences for society overall.
Right. So let's finish this example, though. Yes. If we were continuing on with this, it was just like a single family home.
Yeah.
And then we can dive into the larger assets.
Okay. Under the new proposed legislation, a $300,000 capital gain will have two inclusion rates. Okay. And this is actually a good example here where this is the Canadian with the T-shirt guy. Yeah. He's good.
Yeah.
Okay. So you have a $300,000 capital gain.
Yeah.
All right. There's going to be two tiers to it. The first $250,000 will have an inclusion rate of 50%. So you'll add $125,000 to your taxable income. All right.
Right.
The next 50,000 will have an inclusion rate of 66.67%. So you'll have an inclusion of $33,333.
Yep.
The total taxable income will be $158,333,
Yep.
as opposed to $150,000. Your total tax at your marginal rate of 53.53% will be $84,755 rather than $80,295.
So an extra $5,000, something like that would be
$4,500.
Yeah.
Okay.
Yep.
This is a very simplistic example of how it will work. The reality is the government doesn't care about this $5,000.
Right.
Right? This is going to do nothing for them. What the government is looking at here, and these, maybe this is the examples that they're saying, hey, we're making people pay a little bit more in tax, blah, blah, blah. What they're looking at is Johnny, who bought a piece of farmland back in the 70s and is 85 years old and is about to die, right? And that piece of farmland that he bought for, I don't know, $150,000 is now worth, I don't know, $50 million
Right.
to a developer. Now we have a significant increase in tax and a significant increase in tax revenue for the government. All right. That's what they're looking at. All right. So it's really a measure that is aimed at, let's say, the top percent of asset owners in the country.
Right.
It's not something that's really going to affect your everyday investor.
Now, are there any, I don't want to say strategies around this that you've seen that could help? What's his name? Johnny. That could help Johnny out.
It's just happened so fast that it's too difficult to implement these types of strategies, right? So the capital gains inclusion rate of 50% has over and hasn't always been 50%. I actually have the data here if you're interested. I know back in the 90s it was 66, and then it went to 75. Yeah. So in 1972 it was initially set at 50%.
Yeah.
88 to 89 it was increased to 2/3. Just like
so
this.
88 to 80, okay.
Okay.
Yeah.
1990, it was further raised to 75%. In the year 2000, the inclusion rate was reduced again to 2/3. Then in 2001 until now, right, 50%. So
who was the political party in power?
I mean, we're going to have to go back.
I keep throwing it in there a little bit. I think we know, but anyways.
You can figure it out. Right? I'm not going to sit here and
no problem.
But you know what I'm saying? We can figure it out.
Yeah.
But the idea is that this hasn't been an inclusion rate that's been around forever, 50%. It's arbitrary. Why 50%? Why not 30%? Why not 60%? It's just an inclusion rate. It's still more tax beneficial than interest income, let's say, or business income, for example. But it's not as beneficial as it was last week.
Right. Now, so what we've talked about so far is more on the personal side. Yeah. Now, what about the corporation side? Because sometimes people want to get sophisticated and they put these properties into corporations, but it looks like they're going to get hit even harder. Right.
So when it comes to corporations and trusts, where my understanding is when the trust is taxed rather than if the capital gain is distributed to an individual, right? But when it comes to a corporation or a trust, the entire capital gain goes in the new inclusion rate.
Right.
Okay. So you have to be careful now. I mean, we have a lot of legacy structures that involve corporations, but the government is saying, listen, if you're sophisticated enough to have a corporation, you're rich. Screw you. We're going to take the new inclusion rate.
Right.
Okay. So you have to be careful now about the utilization of a corporation in real estate investing. So, I'm right now I don't like to react fast to these things. I like to look at things over the long run. I'm looking at probably maybe an increase in the utilization of something like a limited partnership. rather than a straight corporation. The reason being is we do want the protection afforded by a corporation, because that's the primary purpose that a lot of people will utilize a corporation for a property in the first. But from the tax perspective, we don't necessarily want to be penalized. So will they apply the same sort of regimen to a limited partnership, which is kind of a hybrid between a partnership and a corporation, meaning that we have limited liability, but a partnership doesn't get taxed. So, it flows the income out.
Right, but that would be moving forward. I mean, if you already bought these properties, they're already in a corporation, there's nothing you can really do. At least
unless you want to sell it in the next week. Right, because it's June 25th is when these rules are going to be set to take effect, right? So if you have stocks in a trading account and, you're like, hey, listen, I was thinking of selling my stock in ABC company and it's got a gain, maybe you may want to consider triggering the gain and paying the tax. But on the same token, once again, if something is a good investment and you would still buy it right now, then why sell? Why trigger the tax? From a time value of money perspective, it doesn't kind of really make that much sense to me.
Right. Yeah. So I think that's good advice, right? Saying, look, you know what? You bought a great property, hold on to it. And let's wait and see. Maybe these things may change because they have been changing since the 70s.
Changed. Yeah,
right.
They change.
And they may change.
They may change over time. Right?
Yeah.
Yeah.
Exactly.
They may change. You look, 1990, it was 75%.
Yeah. Yeah.
And do you think that was in the back of the government's mind, maybe a little revenue boost in the short term here?
Well, yeah, I mean, it's always in the government's mind to get a revenue boost, right? And it depends on the current economic situation that the government is facing and the current, potential, cash flow crisis that they could be facing, right?
Yeah.
That June 25th.
But it's also, where is the money available? So it's very easy for the government to tax, earnings, like just employee earnings, because they're withheld at source. And then the next easiest place, in my opinion, would be securities transactions, because they're reported to the CRA all the time, right? And they're regulated, heavily regulated with securities exchanges. And now real estate. All the money has to flow. It doesn't flow from hand to hand. It goes through lawyers' trust accounts, and it goes. And these transactions are reported digitally to the various regulators. Right.
That's a good point. So essentially, what you're saying is they're stealing revenue from the future.
Yeah.
Yeah. To just get it
padding right now in my pocket. Yeah.
Yeah, for sure. No, that makes sense. And what about your primary residence? So that is still protected for now.
For now. And once again, the policy, and we spoke about this on our previous discussion, but the policy of the government is to allow Canadians to move freely within the country to take advantage of different opportunities, meaning that if you're living in a property, all things equal, and you sell that property at a gain, you're likely going to buy another one when you move. Mm-hmm. So you already have to pay realtor fees, legal fees, land transfer tax, moving costs, so on and so forth. They're saying, hey, listen, you're not doing this to make a profit. You're doing this to make a move, right? So therefore, we're not going to tax you on it. We're going to give you something called the principal residence exemption. All right. And obviously what that has led to is it's led to people treating their home as a tax shelter. Right. And people are buying homes that they have no intention of living in long term, simply for the purpose of renovating or rebuilding and flipping the property for a profit. Right. And how has this been addressed? Well, now you must report that sale. So they're still saying there's no tax, but we want to collect the data on this now. We want to see, what did you buy? What did you buy this property for? How much did you sell it for? How many years have you allocated the principal residence exemption to? Blah, 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 blah. And they're basically getting that data in a more convenient fashion now, rather than scouring for the data, you have to report it on a T2091 on your personal tax return. Okay. So that started in 2016. And then, like I said in our previous discussion, it started a string of action and a string of changes to the way that the government will tax properties.
So why don't we dive into that right now then, right? So I don't know if there's any other questions on capital gains. I think the last one would really be, cottages, that would fall under it as well too, right? That would get hit with it.
Yeah, 100%. Right? If you don't allocate the principal residence exemption to your cottage, because you can, at the exclusion of your house, though.
Right. So hold on. And so this adds another question and maybe even clarity. So let's say now I was living at my primary residence from 1980 to 2020, and then I decide to keep my primary residence, rent it out, and I move to the cottage, and now I'm living there for the last 4 years. How does that work from a tax standpoint? Because you can't have both as primary residence, and it's based on the years that you're there.
It's based on the years, right? So let's say you have 20 years of ownership of the cottage, but 5 of those years you were living in another house and you claim principal residence for those 5 years. You would take the gain, divide it by the number of years in the cottage, and assign that many years to the cottage. So there would be a partial capital gain.
Got it.
On the cottage.
Okay. Just want to make sure it's clear for anybody who's listening.
Yeah.
Okay. So let's go through all the other tax changes, right? And I'll let you kind of take the reins on this, because there seems to be, over the last several years, a very systematic approach in regards to the layering of all these different taxes that we've seen, right? And the structural changes in it.
So the another thing that the government is worried about is obviously the housing, let's call it the housing crisis, right? Yep. Where people are having trouble finding quality places to live. So they can't afford to buy property because property has been jacked up in value, and they can't afford to rent good quality property in major urban centers, major cities in Canada.
I don't even know if my son's ever going to be able to own a home. Unless it's, there's coming from the bank of mom and dad.
Well, that's the problem that we've run into.
Yeah, like 60K, 70K is nothing now.
Well, let's put this into context, right? I'm not even 50 yet, okay? And when I bought my first condo downtown Toronto in a Tridel building, it was a really nice 1-bedroom condo, all right? I had in a year and a half saved up enough to literally put a down payment on the condo. I would have needed CMHC mortgage insurance, but I would have qualified for the mortgage and buy furniture and still afford my car. And I would have had a nice 600 square foot 1-bedroom den condo in a high quality building downtown Toronto. This wasn't even that long ago.
Right.
Right.
And so then what was your income to the price of the home? What was the rate? Like 4 to 1, 4 times your income?
4 times my income for the price of the home. Not even. That's the price of the home with furniture.
Yeah, ours was with myself and Darlene. Yeah, we're 4 times our income as well too. We bought our condo for 120.
I was lucky. My parents were like, "Hey, listen, don't take mortgage insurance. We're going to top you up," and they gave me some money, and I bought the property with like 25% down. Okay.
Yeah.
My total costs were, I don't know, $1,200 a month. It was ridiculous. It was nothing.
Yeah.
It was nothing. Okay. I was earning at the time, I can't even remember what I was earning. Let me put it to you this way. What I was earning back then, I was a new CPA. All right. And I think new CPAs back then were earning about 65 grand a year. Okay. A new CPA in the same situation would be earning right now, let's say 85, maybe 90 a year. Okay.
Yeah.
But that condo, that exact condo that like an idiot I sold would have probably quadrupled in value.
Yeah.
Easily.
Yeah. And so that's the little example right there shows that the income is not keeping up with the price of homes in the Toronto area.
At least in the
GTA.
Toronto area, the GTA area, which is the economic engine of the country, right? So to address this, and there's a number of factors. There's not one factor that has contributed to this. There's the, immigration, foreign investment,
Yep.
Just policies, fiscal policies, monetary policies, interest rates. So many things have contributed to this. So they've realized the need that to combat this, to put a stop to this machine, and put a stop to this bubble, right?
Yep.
So one of the things that they started doing was they started saying, okay, listen, we want to pull in the reins on speculation. So we want to stop speculators, and we really want to stop, foreign investors who have no intention of contributing to Canadian society from just pumping and dumping these properties and artificially increasing the value of these properties to the point where Canadians who are living here are being negatively affected, right?
Okay, so then are you saying then that started back in 2016, 2017 with that whole foreign buyers ban?
Exactly. So
Okay.
like the foreign buyer rules,
Yeah,
right? From an income tax perspective, the principal residence reporting rule,
yeah.
they want to say, okay,
Well,
well,
those 2017?
2016.
2016, okay.
Starting the 2016 tax year,
Yeah.
right? It's like, okay, well, how did this student at U of T buy a $2 million property and then sell it 2 years later for $2.5 million and then went back to wherever they came from and took the money with them? Doesn't make sense, but they claim the principal residence exemption, right? I'm just giving you a random example, right?
Yep.
So they started gathering data is what it looks like. So the principal residence reporting, the anti-property flipping rules, which came into play in 2022, where they said, hey, listen, you flip a property, you buy a property and flip it for a profit within a 365-day period, you're taxed at full rate, not capital gains rate.
Okay.
So we're doubling, in effect, they were doubling the tax rate.
Right.
Okay.
Can we step back to 2017 though? What was there was another couple rules that came in. There was the foreign ban, and there was another one. Do you remember?
I don't remember.
Okay.
No.
I could have sworn there was another one. Maybe I'll look it up. You keep
Yeah,
talking.
no worries. Then in starting with the 2022 taxation year, they wanted something called UHT, or Underused Housing Tax filing, where they're saying, okay, listen, if you have these houses, we don't want ultra rich people or foreigners parking their money in properties, right? Because properties are a natural tax shelter. You don't pay tax on any gain on a property until you sell it, right? We don't want people parking money or laundering money through property in Canada and leaving it unused. You want to buy a property, no problem. Buy a property, but you got to put a tenant in it. It can't just be, sitting around doing nothing. And well, yes, it can be, but you got to pay a tax of 1% or whatever it is on that. So they started collecting that UHT, those UHT filings. Okay.
Right.
Then in addition to that, starting with the December 30th, 2023, they introduced the new trust filing disclosures, meaning that if you had a trust, whether it was an official trust with a deed of settlement or just a bare trust, and I'll explain what a bare trust is, okay, you have to report the beneficial ownership of that trust. So they're collecting data. There's no tax, but you got to tell us the beneficial ownership, all right?
So prior to that, they didn't know who the beneficiary was.
So yeah,
Well, if people were doing their taxes properly, but then that's work on the government side to put two and two together.
listen,
Right.
exactly. So let me first explain what a trust is. A trust is basically a legal arrangement where a settlor transfers assets to a trust, which is a concept, for the benefit of someone else, controlled by a trustee.
Right.
Okay, that is a normal trust arrangement. When would you use something like this? I use trusts very often in my practice. So for example, I want to transfer money. I want to give the benefit of an asset, a piece of property or whatever, to a spendthrift son or daughter, right? So I'll give them the benefit. I'll give them income on an annual basis. They are the owner or the beneficiary to the property, but they can't make any decisions with respect to that property. Some other responsible party will make that decision and give them an allowance, right? That's a typical trust arrangement.
Yep.
A bare trust is something that's very informal. It need not even have a written agreement, right? So, let's say the three of us are like, hey, you know what? We want to get together and buy a property, and we're going to do a joint venture, all right? Even without a written agreement, Gary goes out and buys the property. Like you and I, we transfer 50 grand each to Gary. Gary puts in 50 grand himself, and he says, listen, I've got the capacity to buy this property legally under my name, but I'm going to hold, your portions in trust for you. All right. Mm-hmm. That's a trust. That's like a bare trust or a very informal trust arrangement. Yeah. And these types of arrangements exist in writing and not in writing like crazy all over the place. Think of it like an aging parent. One of our standard probate planning or standard way to protect the aging parent's house is to transfer the property into the son or the daughter's name, and then immediately make a trust declaration stating that the property is actually held for the parent. So in name, it's in my name, and when my mom or dad dies, it'll immediately transfer to me, but really during their lifetime, the asset is held for them. Or I have minor children and I want to set aside money for them to help them out. So I start buying stocks in an account where I am the trustee basically, and they are the beneficiary, a trust account. Okay. Super simple, super common, right?
Now, going back to what you just said now in regards to, let's say now I want to, pass my house on to my son. But before I go, can I sell that to him for $1? Sometimes you go into Geo Warehouse and you see that, right, where it's sold for $1. Right.
Yeah.
What is that, and how does that work?
I believe that's more of a land transfer tax thing, but
so you're not saving on the taxes.
So you can sell something to your son for $1. You can sell at whatever price you want. Mm-hmm. The income tax will come in and deem the transaction to be fair market value. So if I have a piece of property that I've owned for a long time, mm-hmm. all right, and a rental property, and it has a huge gain on it, I can't just give it to my son for $1. Otherwise, no one would ever pay tax. They just continuously pass things down to the next generation over and over again, mm-hmm. without ever paying tax. Okay. So the government will come in and say, I don't care what you do for provincial legislation purposes on paper. It doesn't matter. If that property is worth $1 million, you've transferred it to your son for $1 million. Okay. Right. And it's a lot more complicated than this, because the attribution rules of the Income Tax Act are actually quite confusing, right? But you can't simply just transfer property from one generation to the next without avoiding taxation. You have to pay tax, and there will be a deemed disposition at fair market value. All right. Right. So I want to quash that sort of thing. You can't really get around it, right? Yeah. There are techniques that we utilize to dampen the blow, estate freezes and things like that, but it doesn't eliminate the entire tax burden.
Yeah. I think sometimes people think that it does, right? They're like, I can
smart.
just sell it to my sister or my
like
brother
nobody's ever
freaking
thought about that, right?
Right.
Obviously, like people have been thinking about that since income tax was invented, right?
What are the taxes or changes that happened over the course of the last, 5 or 6 years?
Well, there's a couple of things that have really affected small business owners.
Okay.
Number one, it's going to be this capital gains tax. Okay. Yep. So selling your business, if it doesn't qualify for the lifetime capital gains exemption, or if it exceeds the lifetime capital gains exemption, there's going to be a higher amount of tax payable on the sale of your business. Number two, they've made it much more difficult for small business owners to do two things. One, income split with family members who are in a lower tax bracket. And number two, they made it much more difficult for small business owners that are incorporated to save for retirement.
Okay, so going back to that first one, I think that was where income splitting, if I was a dentist and transferring some of my income over to my spouse, but she had nothing to do with being a dentist.
Exactly. So there was a case that went all the way to the Supreme Court, and it's called Newman versus the Queen, where somebody had a corporation, mm-hmm. and they had a special class of shares that really were worthless, okay, that cost the spouse nothing, all right? They had no votes, nothing, all right? But they allowed for the board of directors to declare discretionary dividends to whomever held the shares. But they could be redeemed by the corporation for $1, let's say, right? So they were just, we called them dividend sprinkling shares. So we would commonly, back in the day, we would set up these companies and we would give the son, the daughter, the spouse, people that were generating no revenue themselves, son and daughter in university or just sitting at home playing video games, all above 18, obviously, because the kiddie tax came into play for people under 18. But we would sprinkle dividends. So you'd have a doctor, for example, in Ontario, and doctors in Ontario, they can give non-voting shares to their family members, parents, whatever, right? And, like an OB, for example, OB makes good money, that works hard, like easily makes $800,000 a year, okay? And there's no expenses, maybe a little bit of auto expenses, a little bit of this, a little bit of that. It's all profit. And, we would give, the husband, 2 kids, mom, dad, we give everybody dividends, right? And because we are in a progressive tax country, in the sense that, at the lower levels of at the lower levels of income, you pay no tax, then you pay 20% tax, then you pay X amount, until you hit the top marginal tax rate. This created massive savings. So we were able to income split without worry. Why? Because this Newman character went to the Supreme Court and won. And the judge, in essence, and I'm going to be butchering this, but in essence said, hey, listen, like if you pay a salary, it's got to be for actual work done. But this ain't a salary. This is a dividend. And if the board of directors says that these profits from the corporation, which are now retained earnings, go out to this person and corporate law allows it, God bless, take the money.
When did this happen? Do you remember?
When was it? I have it here. This was a while ago. Maybe, I don't know, maybe the 80s, 90s, something like that. Okay, you can look it up. Newman.
Okay.
Newman. Yep. It's a super popular case. So went all the way to the Supreme
50,
Court.
60 years ago.
It happened a while ago.
Yeah.
Okay.
Yeah.
Anyways, this basically, this technique of income splitting and creating dividend sprinkling shares, or Newman shares, as sometimes people in the tax community call it, it went rampant. Everybody did it. It was perfectly legal.
So then how were they able to then, I guess, circumvent that?
They created the tax on split income rules, which are very, very complicated and hard to understand. So I don't want to waste our time kind of going through the details on it. But they essentially quashed that. And they said, listen, you can give dividends to whoever you want, but you're going to get hit with this additional layer of tax. Like you're going to get hit with a high tax rate. Unless you meet these exemptions, right? And there's certain exemptions, such as the primary shareholder reaches the age of 65. Okay, well, now you're retired and we want to income split in retirement anyways. Go ahead, have fun. Or if the spouse, for example, or the adult or the children are actually, if the spouse is actually working in the business and you can prove that the spouse is working X amount of hours over a certain number of periods. So there's all these exemptions.
Right.
The net effect is everyone's afraid to give dividends to family members now. And it's in effect, it's probably been pretty effective at squashing blatant income splitting amongst people that are not even really running a small business, right? So it's pure service-based businesses, right? Because if it's a product-based business, you're not necessarily subject to the TOSI rules.
Right.
Okay. So that's one of the major things that they did. They squashed the artificial splitting of income for things that are, for businesses that are purely service-based, like a doctor, a dentist, an IT consultant, an accountant, a lawyer, like a realtor, for example. It's like it's a purely service-based business based on that one particular professional.
Okay.
All right.
So with all these tax changes, somebody's listening to this like, God damn, this is depressing, Fabio.
Yeah.
Okay, what can they do to, I guess, protect themselves? I mean, this is now where you get into like estate planning and life insurance planning, and I know you've helped myself and Darlene set us up with this type of stuff. Can you maybe kind of go through some tips and strategies on what they should probably do?
Right. Well, the first thing that they need to do is they need to understand what their sources of income are and what their sources of wealth are. Okay. If your source of income and your source of wealth is employment income, there's very little that you can do from a tax perspective because you're getting taxed at source, right? The second thing that they have to realize is that
so hold on. So this is what you're talking about now. You got to get into like almost like that self-employment type of realm.
If you're if you're self-employed, it becomes a lot more complicated, right? But if you're not, there's very little you can do at source. There's pretty much nothing you can do at source.
Right. Yeah.
All right. Then comes investment. The traditional methodology for investment, in my mind, doesn't change. Just because capital gains inclusion rates are increasing, right? Or property flipping rules have been implemented, or UHT has to be reported, it doesn't change the fact that you're still looking for a quality investment that fits your risk profile. So if real estate if you're going to sit there and complain about an increase in taxable capital gains, well, what's your alternative?
Right.
You have to invest in something. You're not just going to keep the money in cash. You're screwed if you do that. You're going to lose your purchasing power.
Yeah.
So work around the rules to the best of your ability. Don't flip properties.
Right. And just to back up there for people to understand, what you're saying is don't keep your money in the bank because you will not be able to outpace inflation just by doing that. It's got to be invested in something.
By definition, you won't outpace inflation.
Yeah.
You've got to do something else. And regardless of what the tax consequences are, right, you're going to have to invest in something. Does this make property a crappy investment? No, it doesn't. It just means you're going to get taxed a little bit more down the road. Right. Does this mean that you shouldn't incorporate a company because you can't income split with your dog, your cat, your wife, No, of course not, right? There's still benefits to incorporating a company. There's still tax benefits, especially if you are reinvesting in the business. And that's what the government wants. The government wants you to incorporate a company, be self-employed, and reinvest in the business, grow the business so that you can hire more Canadians. That was the whole point of a preferential tax rate for a corporation in the first place. But then people started abusing it. Right?
Now, so two things. So number one, are you seeing small businesses leave Canada? Are you seeing any of that starting to happen now? Or is it just more they're complaining about it, like this is bullshit and fine, whatever?
Yeah. I mean, okay. Am I seeing, I once again, I'm not tracking the data.
Yeah.
But amongst my circle, which once again, my clientele is going to be mass affluent and up, self-employed individuals, self-employed small business owners, and real estate investors. Am I seeing an exodus of people? No. It's very difficult to immigrate to a new country, even if it's, let's say, the United States, and then set up shop there. However, what has been happening with my clientele is there's been a lot of interest, and some people have pulled the trigger on investing south of the border, on buying property south of the border, on expanding their businesses south of the border. There has. And whether that has coincided with the policies implemented by the current government or not, I don't know. Or is it that they're seeing opportunities, and as they age, they have more capital. They're trying to seize those opportunities. Yeah. I can't really tell you, but I can tell you with absolute certainty that anecdotally, I can tell you there's a lot of complaining.
Yeah.
And a lot of, whether they're true or not, threats about I'm going to pick up and leave.
Yeah.
Right.
I'm hearing that a lot as well too. And I'm sure also the interest rates has made it more difficult because, last year our business got impacted significantly, right? I thought I had a recession-proof business working with investors, and they dried right up. Now, because the numbers didn't make sense anymore. Like, even out in Peterborough, you can only do really student rentals queue.
Mm-hmm.
That's really the thing, like a 2-unit conversion either doesn't work.
Yeah.
So it does make it more
But remember,
difficult.
this isn't the first time we've had horrible. I mean, I wouldn't even say the interest rates are horrible. They're probably somewhat normalized now, maybe a little bit higher than they should be. But, you go back to like the late 80s, the early 90s, people were getting hammered. The interest rates were ridiculous back then.
Yeah.
But the market still survived.
Yeah.
People still were able to still find value, right?
This is almost like a flushing, though. It's a flushing out of speculators. This happened back in the late 80s. Like, everybody thought real estate was the way to go, and they're going to, buy all these pre-construction, and then all of a sudden they got crushed.
They got
by the interest
hammered.
rate.
Yeah.
And then they get out, and all of a sudden they're back in their cubicle, and Bob's like, I told you real estate investing wasn't easy. And then they leave the market for a number of years.
I saw a crazy statistic. I don't know how many realtors are in the GTA.
70,000,
Right?
75,000.
And I'm probably butchering the data, but I think like of that 70,000, something like 40% of them didn't even close one deal last year.
Yeah, you're probably right.
Which means that there's a lot of part-timers playing real estate.
Yep.
Playing realtor, playing real estate investor. And I think that what's going to happen in these natural cycles in the economy, overborrowing, increased money supply, these are natural cycles. You can follow these back from all the way to the days where money was first invented. It's not something new here, right? These cycles are, in my opinion, opportunities for people that have capital to really start acquiring good quality long-term assets.
I agree. I do. I think now is a great buying opportunity for sure. If you're smart and you use fundamentals, right? And not speculate.
And if you have a long-term horizon.
Yeah.
Right? If you have a long-term horizon, I mean, the world is really your oyster when it comes to, especially in a safe country like Canada or the United States, the UK, Australia. Like these countries are, the government's not going to swoop in and just take your assets. Gangsters aren't going to show up looking for gangster tax.
Right.
You know what I mean? These are very easy countries for people to earn if they are patient and play the long game.
I agree. Let's wrap it up with this. We started getting into it, but in regards to life insurance and
Yes.
and also estate planning, just
Yeah.
maybe 4 or 5 minutes on it. What
Sure.
Yeah.
So life insurance in Canada is still a tax shelter, still a legal tax shelter, in the sense that if you are to buy a permanent life insurance policy, either a universal life policy or a whole life policy, depending on certain thresholds as dictated by the Income Tax Act and calculations done by actuaries, you can over-contribute to those policies, generally to the tune of 10 times the original base premium, all right?
Yep.
Into a side pocket account that we refer to as a cash surrender value or a cash account. That cash account grows in value over time, much like a TFSA grows in value over time. And the death benefit, when structured correctly, of course, will come to the beneficiaries or to the estate tax-free, meaning that in essence, you can invest tax-free a large amount of money. So for families that have money trapped inside of a corporation or have exhausted their TFSAs, RRSPs, LIRAs, and other sort of traditional taxable accounts, and have a need for estate protection through life insurance, it is something worth considering, definitely, as part of the overall investment financial plan, estate plan for the particular investor, for the particular family. A great example, a simplified example. Mom and dad, both mid-level executives at a big bank, let's say, earn income in the highest tax bracket. They're in their 40s. They've maxed out RSPs, maxed out TFSAs, maybe have 1 or 2 rental properties, and they don't want any more, but they still have an extra $50,000, $60,000, $70,000 a year that they want to put somewhere. They don't want to really pay tax, and they don't want to buy any more investment properties. They've got a couple of kids that are relying on them, and they want to pass the cottage to the kids, the investment properties to the kids, and they're whatever it is. Like, they want to pass assets to the kids. They can purchase a whole life insurance policy, over contribute to it, get a tax-free dividend on an annual basis, build up a massive amount of money in it, way more than what their TFSA will have. Access that money tax-free in retirement to supplement their retirement income, literally tax-free, and then have the entire thing unwind tax-free at death, so that they can pay their estate estate tax bill.
And when you say supplement their income, because now that money is still invested in whatever it is that it's in, right? Making 6, 7, 8%, whatever it is. They now can take that policy to the bank.
Well, they could do a number of things.
Yeah.
If you want to do it purely tax-free based on current legislation, right, you would take the money, the policy, assign it to a bank as collateral for a loan or a series of loans, okay, and then borrow as needed with really no requirement to repay the loan ever or even service the interest, as long as you don't exceed the loan-to-value percentage that you've been approved for, right? They can use that money for whatever purposes they want. If they use it for investment purposes, it's actually extremely tax efficient, because they'll be able to take tax deductions for the interest that accrues and is paid, and a portion of the insurance payment if it exists, okay? And literally write that all off, right? But if they just want to use it to live, to supplement their income, it's a non-taxable, borrowing is not taxed, right?
So you're saying they just live off of that income and not worry about paying it off, and then eventually you cease to exist, and then it's done.
And then it's unwound. Then when they die, the death benefit is paid first to service the debt, or to extinguish the debt, with the remainder paid to the estate.
Because what is still vested or being invested is still going to continue to grow faster than what you can spend at, essentially?
Yeah, well, you cannot exceed loan to value on it. It's basically, like this, a similar concept to a reverse mortgage almost.
Right.
Yeah. On a property, right? Okay. The idea is that if done with a whole life policy, this can also be done with a universal life policy as well, but it's a little trickier and more complicated to understand. But for your listeners, if it's done with a whole life policy, you can quote unquote reverse mortgage that policy, and the banks are very happy to give you up to 90% loan to value on that thing. Why? Because of the way that the policy's cash value or the participating account is invested, right? Super conservative, super steady, and has historically always paid a return. Now, obviously, there's no guarantee on anything, but it's always paid a steady return, which is smoothed out over time. So they have a very strong asset base for collateral.
Right. And this has been around for like hundreds of years, correct?
Since like the 1800s.
Yeah.
Right.
Yeah. And this is what everybody's kind of talking about now, infinite banking.
Right.
This is the name of infinite banking.
Yeah. And what I want, actually, I wanted to let you know, my first book, I've almost finished writing it, and it's actually in the editing process. And it's tentatively titled The Whole Life Solution, where short book, 100 pages, right? Where I go through what a whole life policy is and the problems that it can solve, along with some examples of how to get creative with these things in order to solve all these different types of problems: legal problems, tax problems, cash flow problems, investment volatility problems, so on and so forth. And the reason I don't like that term infinite banking is it's really marketing, and it's really pigeonholes what a whole life policy is into one avenue. The reality is a whole life policy is a very versatile tool, financial planning tool that, usually a high net worth family up to ultra high net worth family can utilize to solve a bunch of different problems. And it's up to the creativity of the financial planner and the tax planner to structure these things in such a way to solve these particular problems.
Yeah, and you know what? Every time I go to an event and I see somebody talking about it, I'm always learning something new. Like it's not something you can sit down and say, okay, I got it. It does take time to kind of, understand.
There's a lot to understand. Like I have, I don't even know, like I have a book that I buy the new edition all the time, and it's Manulife produces it, and it's called The Taxation of Real Estate. The Taxation of Life Insurance. So this book is literally just on the taxation of life insurance. It's about yay thick, like 2 inches thick, and it just gets into the basics. And that's just the taxation of life insurance.
Right.
Then there's the law of life insurance contracts. Then there's actuarial calculations involved. Then there's the investment portfolio involved with it. It's such a broad topic, and people don't realize how complicated and broad life insurance and life insurance companies are. So it's just, in my opinion, a tool. And like I said, I struggled to keep this book down to 100 pages because I wanted somebody to be able to read it in a couple of hours.
Right. And
just, okay, I understand it. And it's not written from a technical perspective. It's written for just the general population.
Okay. Well, I'll have to get that book. Can we get the, do you think it'll be ready by August?
It better be. it better be.
All right,
yeah,
cool.
I'm gonna give you you guys like one of the first copies.
All right, awesome. Sure. If it is, and we'll definitely add the link in the show notes below. Anything else on taxes and life insurance that you want to maybe finish it off with?
You know what?
Yeah.
I guess the main thing I want to finish off is I don't want people to. I want people to cut through the noise. I don't want people to look at government policies, taxation, complexities as some sort of an excuse to not invest and not look for opportunities. There's always opportunities out there, right? Mm-hmm. If you're smart with your money, at least from what I've seen anecdotally from my clientele base, right? If you're smart with your money, you always have a reserve of cash, all right? And you don't overextend yourself or over leverage yourself. There's always going to be an opportunity in the market. If you look to history, there's always an opportunity in the market. And if you're patient, you will make money. You will improve your life. You will be able to take yourself to the next level. So that's kind of what I want. That's what I tell my clients all the time when they're down. They're like, oh, I had this plan and it's all been thrown under the bus because of this government, or this happened or that, or property values went down.
Yep.
Who cares? Just be smart and play the long game.
I agree. You couldn't have said that any better, Fabio. Thank you very much for your time. Thanks for all that information. Q, anything you want to wrap up with?
I want to tell the people, don't underestimate the value of tax planning. Fabio reiterated, it's not about the money you make, it's about the money you keep in your pocket. Gary and myself, we deal with our clients. We don't have time to understand all the tax laws and all the updates. That's why you need a professional in your corner that can give you the solid advice that you need.
100%. And Fabio is in my corner. Thank you, brother, because I could not have figured this thing out on my own. That I can tell you. So I trust you. Thanks, brother. I appreciate your time.
Of course, anytime.
All right, guys. Take it easy.
Take care.